You're looking at a trade on the Russell 2000 ETF that I'm up $31,000 on. But whether you trade Forex, commodities, indices, or whatever, today I'm going to tell you about my approach to trailing stops and how I use them to catch huge moves in the markets every once in a while. Let's jump in. Now, first up, let's do a simple definition of what a trailing stop actually is and what this means. Now, trailing stops in general are a really simple concept. It is essentially when you take an entry on a trade, like for example, the one that we've got pulled up. I went long the IWM ETF right here around $201.16 per share, and I had a stop loss just below this area, somewhere around the high 198s, 197, somewhere in that range. My initial stop loss here was below where I entered the trade. In fact, if we were to use the TradingView tool here, the long position tool, approximately I had a stop loss just below here. And I don't have a take profit. Now, although I'm showing a take profit here, ignore this top half for just a second, and let's just focus on the red zone. So I entered into the trade with a stop loss here. But as the trade has progressed, I've actually taken this initial stop loss and moved it further into profit over time. And at this point, for a bit of context, I've actually moved my stop loss on two different occasions from my initial trade. So initially, I had a stop loss at this current level. Then when we broke out, I actually took my stop loss and I put it below this market structure low. And now I've actually trailed it a second time to where it currently sits at 211.24. So in a really simple definition, a trailing stop loss is essentially a stop loss that moves with price action as things progress, gradually locking in more on the trade in the event that the market were to turn around. So for example, I'm in a long position still from my initial entry over here, but if the market were to reverse and break this level of support, I would stop out. Now, I wouldn't stop out for a loss, I would stop out for a profit, because this is a trailing stop that has been moved into profit. So I can't lose money on this position unless we had some sort of ginormous gap lower, which is very unlikely. But the main point of a trailing stop loss is to gradually lock in more profits on the trade. And let's just say this thing were to move higher, I could essentially continuously move my stop loss further and further into profit. By the way, on the screen right now, you can see the QR code to join our free Telegram channel. Inside of the Telegram channel, we're sharing free daily market analysis between myself and Alan. We're sharing stuff each and every day on market commentary, what's happening in the latest news reports and economic data, price action, trades we're in, and all sorts of stuff. If you'd like to explore the Telegram channel and join for free, the link is in the description below. Now back to the video, which brings me to the next part of this video, talking about the pros of using a trailing stop and the main reasons why I love using it in my momentum trading style. So here's a few pros of using a trailing stop loss. The first one is the most important one of the entire list. When using a trailing stop loss, as I just showed you with the example, my stop loss could theoretically continue to trail higher and higher indefinitely, essentially giving me an unlimited profit potential if the market continues to move in one direction for a very extended period of time. Now, we'll get into the downsides here in just a moment, but a little bit of a sneak preview. Most of the time, the market does not move in one direction forever. However, there are occasional trends that just rocket ship in one direction and allow for this sort of scenario to look really attractive. The unlimited profit potential can lead to absolutely massive winners with a trailing stop loss. The second reason I absolutely love using trailing stop losses in my momentum trading strategy is the idea of simply following the market rather than trying to predict where the market will turn. When traders use a strict take profit, the challenge of using a strict take profit is you don't know exactly when the market is going to stop trending. And if you really have a good trade and the trend is really strong, I'm a believer that you probably shouldn't try to call the top of a trend that is trending really well. For example, let's just say with my IWM trade, had I put a take profit here, I would have capped my upside and given away some of the potential gains that we saw since then. Now, of course, there are pros to doing it this way too, because sometimes the market does not follow through and you locked something in. Again, there is no perfect way to exit the market, but what I like with the trailing stop approach is that hypothetically, there is an unlimited profit potential, and we simply rely on the market to tell us when it's time to get out of the trade rather than trying to predict where the top of a trend is. So in this case, or a bottom if we're shorting the market. In this case, because we're long, the idea is we are simply following the market, and each time we put in some sort of higher low, then what we do here is we just lock in more on the trade and continuously do so until the market tells us it's time to get out of the position. So essentially, we are a trend follower with a trailing stop approach. Now, in a second, I will show you the methodology that I use to trail stops. We'll get into the technical components in just a bit in this video. Feel free to skip ahead if you'd like. Another component that I absolutely love is, for me personally, it's very comfortable. Now, this is personal preference. Some traders really do not like trailing stops because the downsides that we're about to get into. But for me, the simplicity of a trailing stop loss and allowing myself to just sort of follow along with the market and the unlimited profit potential for really great trends when I catch them makes trailing stops worth the cons that I'm about to show you. Let's now talk about some of the cons of using a trailing stop loss method in your trend following trading approach. The first one is very obvious, and I do want to just say I've traded with a trailing stop for many years now, and no matter what strategy you choose, before we pick on any particular exit strategy or technical entry or exit or whatever, there's always a way to poke holes in any approach. And at the end of the day, it's sort of a pick your poison type of thing when it comes to trading different exit styles. But trailing stops for my momentum style of trading is my preferred poison, if you will, quote unquote. Let's talk about the cons. So first one is that the market rarely follows through in one singular direction for a very suspended period of time. So by their very nature, trailing stops are a high lose rate or high give back rate strategy with the occasional massive return winner. Now, again, the market oftentimes goes sideways, and many traders find trailing stops frustrating because instead of banking profits before the market reverses, they often hold on to those and give back gains that they may have otherwise been able to capitalize on. This is easily the most frustrating part of using a trailing stop. The other one is that lots of small losses and lots of small winners is the norm for trailing stops. In fact, it is very normal to lose more often than you win with a trailing stop methodology, because essentially you need to wait for some sort of big move to really start trailing a stop loss, in which case you're going to inevitably have more trades that sort of just result in a small loss and a lot of false starts, if you will. Additionally, sometimes you have a good trade that starts, but doesn't follow through enough and you end up giving it back or just taking a small winner. This can be very frustrating to wait for the big trade that you're looking for, because again, it's very infrequent that you get market moves that are just single direction, follow through, massive trends in the market. It's actually quite rare to get that. Now, as I said earlier, to me, it's worth the wait and worth the pain and suffering, if you will, to get there. But the last one that I want to point out is that with trailing stop losses, sideways markets are an absolute problem. When the market is going sideways, you end up giving back the majority, or this is where you're going to give back majority of your gains, or you're going to enter into really tough losing streaks. Now, no matter what strategy you choose, like I said earlier, you're going to have losing streaks and drawdowns. But sideways markets are the bane of the existence of the trailing stop trader, because again, inevitably when you enter into that sideways market, if you get a market that looks like it's going to go and then you buy and then it goes back down, or it looks like it's going to break down and then you get short and then the market pops back up, right? That is the bane of the existence of someone who is trailing a stop loss. And so these are the cons that you need to be aware of. Now, if you reversed all of this, there are also trading strategies that people like to do the opposite with, which is to take profits quickly and to build into losing trades, which actually can also work. And regardless of whether or not you use a trailing stop methodology or something else, The key to all of this is that in order to survive the sideways markets and the frustrating losing streaks that you are inevitably going to have with any strategy, the reality is small positions are the savior to any exit style. Any strategy where you're taking too big of a risk per trade is likely to blow up in the long term. But if you take small enough positioning, you're much more likely to survive the drawdowns. Let's now actually get into the technicalities of how I personally like to trail stops. Now, there are ways that you can do this on a more methodical basis, and there are other ways that I don't personally use, but many traders do use. So I'm going to show you my trading style where it comes to trailing stops, and then I'll show you some other common practices. So for me, on a technical basis, which is, by the way, not the only way I enter and exit trades, I do use a large amount of my process is fundamental analysis or macroeconomic data to determine whether or not I want to be long or short a particular asset, currency, index, whatever. But when it comes to purely what we're talking about in this video, the technical exit strategy that I use with my momentum trading strategy on things like the Russell, the S&P 500, gold, NASDAQ, things like that, I'm going to talk about the technical way that I trail stops. So let's just say that I see a market that is in an uptrend, essentially using the textbook definition of higher lows and higher highs. What I'm going to do in this circumstance is, let's say that I'm deciding I want to get long. And so we have an area of consolidation, we break out, and I'm looking to get long here. The way I would approach this is that if I'm getting long here and I have an initial stop loss below market structure here, my plan is to look to see what market structure does next. If the market comes down and stops me out, I'm out of the trade. And that's the end of the trade, and I'm on to the next one. And this will happen a lot because inevitably, when you have a tight stop loss, you're going to have more losers than winners. It's just the name of the game. You can't have your cake and eat it too when it comes to trading. Everybody would love to tell you on social media that it's very easy to have a super high win rate on a 5-to-1 risk to reward, but that is just unrealistic in the real market environment, which has many millions of variables as to what's going to cause price to go next. And anybody who tells you they can predict perfectly what price is going to do is probably trying to sell you something that you shouldn't buy. When it comes to trading, we want to be really practical and recognize that sometimes you're just going to stop out, and that's okay. Nobody's perfect. No trading strategy or exit style is perfect. Now, when it comes to my style, if I stop out, I stop out. However, if I see the market start to move in my favor, this is where things start to get interesting. What I typically look for is at least a return to the previous high, or in a down market, the previous low, before looking to trail a stop loss. This is the bare minimum for me. What I'm also looking for really to start moving a stop loss is some sort of higher low in the direction of the trend that I'm trading. So in this case, upon the breakout here at this impulsive moment, when the market has now officially broken out and cleared this previous high, a new higher high is my instance at which point I am looking to actually take this stop loss and now move it into profit. So now what have I done? I've moved my stop loss, which was initially here, further into profit. And so essentially what I just did there is the entire approach. And I rinse and repeat until the market reverses and hits my stop loss. So let's just say that again, we get some sort of consolidation and then we shoot through yet again a new high. In this case, you can see we broke out and we put in another higher high. At this point, what have I done? Well, I've broken through the previous high, and I've also got a nice point to put a higher low, which I'm going to use, just like I did over here, as my new stop loss placement. So I'm going to move my stop loss right up behind this higher low. Now I know this is really simple stuff, but to me, simple is better when it comes to trading. I don't need to get all fancy with this stuff. And this is going to adequately keep me in the market when the market is trending. And when this market starts to reverse, let's just say that we get this and then we shoot up, right? And I trail my stop loss one last time right here. And then the market completely fails out and we reverse and I stop out. In this case, my initial trade went from this entry here and I held all through here until ultimately, let me redraw that. I ultimately got stopped out right here. So that is how I trail stops. It is a really simplistic way of using support and resistance or market structure to highlight when it's time to trail my stop loss and when it's time for the market to tell me it's time to get out of the trade. Now, of course, we would flip all of this around if we were talking about a short example. Let's just say that I got short and I think that the market is going to continue lower. If I'm wrong, I stop out. And I could put my stop loss here. In this case, we'll use a blue line to buy back my position, right? So I'm short, and then the market continues to trend lower. We take out the previous lows, at which point I'd be looking for a lower high in order to trail stops. But Nick, what if you don't get a higher low? Or I'm sorry, a lower high? What do you do in that case? What if you just get a break straight through? Well, in this case, what I'll use is I will still reference this previous breakout low as kind of my new level of resistance, right? So I'm either using a lower high in this circumstance or just a breakthrough structure, at which point now I could take my stop loss and move it right here. So again, a very simplistic idea of using market structure to highlight where I want to move my stop. And again, I'm just following price until ultimately the market shows me, okay, it's reversing. Now, here's a frustrating example. Let's say I had this big short gain, right? This market's moving lower, and I don't really have an instance here to move my stop loss any further closer to price. What I'll do, right? Because I could get a little tighter if I wanted to. I could put it right there. But let's just say that I saw this lower high and I want to trail stops a little bit looser. Now, I do have some criteria, some discretion that comes into my own approach. It's not 100% mechanical, and a lot of what I do is based on fundamental analysis. But we're not talking about that in this video. If you'd like to explore more of my fundamental analysis and approach, I'll leave a playlist linked in the top right hand of your screen right now. Let's just say in this case, the market reverses all the way. In this case, yes, I would have given back a lot of the profits that were on the trade. This is the price you pay when trailing stops, because oftentimes the market does this, where it looks really good and then it snaps all the way back, giving back some profits and even kind of making you feel a little dumb. Another thing that's kind of frustrating about trailing stops is that inevitably I'm always giving back something, right? Anytime I get stopped out of a position, I'm giving back something that I had in terms of profits, because I'm never technically closing at the end of the move per se. I'm closing at the very tip of the move or bottom of the move. Rather, I'm closing when the market's starting to show signs of going back the other way. So inevitably what this means is I cap my I keep my possible gains unlimited, but oftentimes I do give back some of the gains that I had. So it's a pros and cons kind of thing, like we did in the beginning of this video. Let's now talk about another trailing stop method. And actually, before I do that, let me show you my example now with your understanding of my strategy with this real example on this IWM trade that I'm in. So I went long on the break and retest of this previous area of resistance. We gapped higher, we filled that gap, came down to support, and I got long on the trade. I put a stop loss below structure, looking left, and then when the market started to move through these highs, that's where I put my stop loss below structure here. Now you don't see it there because I've moved my stop loss since, but my stop loss was moved, like I said, just below this market structure point here. Then the market pushed through these previous highs once more, at which point I have moved my stop loss once again further into profit. And from here, if the market continues to push higher and does something like this, for example, then yes, I will continue to move my stop loss further into profit until ultimately the market decides to reverse, giving back gains and stopping me out for a profit. Now I'm going to show you another trailing stop method that I think is a very simplistic but really powerful way to trail stops as well. Now, this is not what I personally do. I do like to use market structure, but many people love using moving averages to actually help trail their stops. So in this case, let's just say for whatever reason, we got long the SPX on the break of this, let's say we just broke these highs and we got long here at the end of the day. So we got long right there, right? I know it's a perfect cherry picked example, but bear with me. Let's say I'm long right here and I'm still in the trade because my criteria for this one is so simple that all we're going to do is say if the market closes below the 20-period moving average, that's our trailing stop, right? So we're just simply going to say, hold, 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 hold. Every day we check. And if the market closes below the 20 period moving average, then we close the trade. Simple enough, right? Well, of course, there are pros and cons with everything, and this helps to really visualize what the downsides of trailing stops as well. By our very definition, had we shorted the market here and then closed here, based on our definition, we just took a loss there. And then let's say we reverse the trade. We got long here, and then what do we have to do? We have to close it here because the market closed back the other direction. Then we got short, and the market did what? Well, it moved a little bit lower, kept moving, and then we closed out here for essentially break even. So you can see that once you go into a sideways market environment, trailing stops are very frustrating, and that is the pros and cons of everything in trading, right? There are times where this entry would have been really strong. You would have taken the short position here and then closed right there. So that would have been a really profitable trade. But with every approach, nothing is perfect. Now, again, whether you choose to use a moving average, whether you use market structure like myself, or what some traders do is a purely mechanical trailing stop where if the market moves a certain amount, whether it be pips, percentage, points, whatever market you trade, right? This is applicable to Forex, it's applicable to indices, commodities, whatever, futures. The idea is basically we're looking for a market in a mechanical trailing stop or an automated trailing stop. The idea is that every time the market moves by a certain distance, the stop loss is just mechanically trailing. Let me try and express this a little bit better. So let's say, going back to our example, that you were long right here, and you were saying anytime the market moved, let's say 2% above, anytime it got 2% or greater, keep the stop loss 2% below, right? So let's say our initial stop loss was 2% below this level. So we had a stop loss initially here, and this stop loss is going to straight up trail what's happening in this market. So if we move up by 2%, this stop loss is going to just grind higher and follow that until it gets stopped out. So some traders prefer to do that. I personally have never really liked that because I think that kind of ignores market price action. And I kind of like to keep an idea of what's happening in the market price action rather than simply just using a hard-coded trailing stop loss. But some traders do prefer to use that as it is very mechanical and requires less sort of discretion from support and resistance. Although moving averages are kind of a nice middle ground. It adheres to what's happening in price action, but it's also not it's also very mechanical as well. So whatever you like to do, go for it. For me, this is my approach to trailing stop losses. I hope this was helpful to you, and thank you for watching. If you're looking for a better brokerage, then stick around for a second. I'm going to tell you how you can get some free sign-up perks with great brokerages all around the world. Whether you trade FX or indices, commodities, futures, all of the above, I'm going to show you a really cool way that you can get free sign-up perks with your new account. So if you're interested in switching into a different brokerage, you can get things like deposit bonuses or free stock shares, or you can even get access to some of our products for completely free. All you have to do to find out current perks being offered to new depositors is go to a1trading.com/brokers. That's a1trading.com/brokers. And as you look at that page, you'll see all these different offerings that we've currently locked down for you guys as subscribers, as viewers. Now, of course, we get something out of this. If you choose to use these links, you'll be supporting our page. But in return for the viewers, we've got great sign-up perks available for you guys so that you get some free game just by signing up for a brokerage if you're looking to do so. So check it out on our website. You can find current deals at a1trading.com/brokers. Thanks for watching this video, and on the screen right now you'll see some other options of other videos we put together that might be helpful to you in your trading career. So thanks for watching, and we'll see you next time.